Hello and welcome to the Weekend Investing Daily Bite of 1st of April. Very topsy-turvy day. The market started with gap down, immediately closed the gap on the higher side, and trapped the bears from the morning as well as from the previous session. And then in the subsequent hours, collapsed below the day's low again, and finally ending at near the low point. So a very dramatic day in the markets. Certainly not what one was looking for to start the month with. But then we have the April 2nd, uh, you know, fear that is there in the market that Trump is going to put reciprocal tariffs, and that narrative also probably should come to a rest post tomorrow. So this fear should go away. Some certainty should come back. I think that is a way forward for the market, and of course, the results for the March ending season will also be coming in the next couple of weeks, and that probably is going to be the trigger along with the interest rate meet coming up very soon in April. So these are some of the things that is driving the markets. We've had some great weeks, 2 weeks prior to this, and we are now correcting. Um, is the Nifty 50 also a momentum strategy? We will have a brief discussion on this. A lot of folks don't see these indices as momentum indices. I'll show you some data and a perspective where you may start to appreciate that the entire market is geared towards momentum only. Do read the disclaimer, of course, fully and fully understand the clauses here. Uh, do subscribe to the channel if you haven't so far, and certainly like the videos. Where is the market headed? So, if we look at the market down 1.5%. You can't see in the picture, but it opened down, then went up, and then collapsed again. From the top, of course, we are down significantly, but you can see that this time around the pullback came exactly to where the previous pivot was, which was not happening earlier. So there is now a chance that we may find some bottom somewhere here and start to try and build that up, because that will really be explosive for the market, given that an inverse head and shoulders pattern is possible. There's no certainty, there is no high probability of that happening, but the fact remains that any bottom which is higher than this probably is going to get another shot at 23,800. Of course, if we break this, then the trend remains downwards, and we just had a sort of a brief optimism rally here. Nifty Junior also down 1.06%, better than Nifty. Mid caps down 1%. Very surprising that mid caps did not fall much more than Nifty. It does show that most likely FIIs were the culprits again today. We'll know the numbers later in the evening. Small caps down only 0.5%. So that is the saving grace right now, where small caps have not even broken the very recent 2 day back low that we created. Bank Nifty, of course, was down. Bank Nifty 1.43%. Again, a lot of FII action in Bank Nifty. Gold up 0.5% on this chart, but actually speaking, from Friday's close for India, we are up almost, I think, 2.5 or 3%. The trading view has simulated a candle for Monday as well, but actually speaking, it is 2 to 2.5% from Friday. So gold is really going, really doing what it's supposed to do. In the sense that when the market is uncertain, when there is a lot of probability of things going wrong, gold goes up, and that's what it is doing. A good allocation to gold would have prevented your portfolio from bleeding very hard, and would have achieved the insurance and the hedging purpose of that portfolio. Market breadth, not so bad, I would say. If we see Nifty 500, we are at 205 to 291. So yes, in favor of bears, but not so bad actually, I would say. Heat maps, some stocks really gave it up. So HDFC Bank leading the markets down 3.3%. Bajaj Finance almost 3%. Bajaj Finserv 3.5%. Reliance 1.7%. And IT stocks just getting smashed. Infosys, HCL Tech, TCS, and Tech Mahindra. Wipro survived today. Bharat Electronics is the PSC that was smashed down. ITC, Levers also down. Titan, Sun Pharma, L&T, almost everything was down. Trent was one lone man standing up at 4.72%, and IndusInd Bank also up mildly. In the Nifty Next 50 space, you had much more uh, deeper red. So DLF, Lodha, Chola Finance, REC, Bajaj Holding, Adani, ABB, CG Power, Divi's Lab, Naukri. Some of these stocks were really hammered very hard. IOC, BPCL, Indian Hotel Gas Authority, they did well. HAL did well after the order. Motherson also was flat. These are some of the stocks in the Nifty Next 50 space. Within the indices, almost everything was down except media. So media performed very well today, 2.4% on that space. PSU banks were flat. That is a saving grace for a day like this, that PSU banks did not fall. Public sector enterprise stocks also did not fall. So I think the leadership of the fall guys is changing. It is no longer the public sector stocks which fall for the first. Rather, it is IT and real estate which is falling the most. Pharma and banking also falling along with that. The private banking especially. Uh, Over the last 1 week now, the best gainers include the PSU banks and the Nifty Bank Index as a whole. Real estate, pharma, autos have lost the most, along with media, for the last 1 week. Here you can see some of the media stocks that was leading the rally today. So Dish, TV, PVR, Hathway, Z, these stocks were up, and they are pretty much tagging the 40-day moving average on the Nifty Media Index. Okay, now let's look at uh, the topic of the day. Is Nifty 50 also momentum strategy? So you must have read about this, that very recently the semi-annual index rejig has been done. So all indices on the, let's take the example of National Stock Exchange, are reviewed and changed every 6 months. So every 6 months there is a circular that will come out from the exchange that from 1st of April, this is the new index, and there will be some stock changes. Some stocks will enter, of course, some stocks have to leave then. So this time, Zomato and Geo Financial Services have come into Nifty, and BPCL and Britannia have gone out from the Nifty. Similarly, there are other indices: Nifty, CNX 200, mid and small cap 400, small cap 250. So many other indices are Nifty Next 50 is there. So usually the question that is asked is, does momentum work? So we want to, bring these two uh, thesis together about the index churn and momentum as a strategy, and show you some data. So the claim is that the index is also a momentum strategy. Why we are saying that is that, what is a momentum strategy? That you ride winners and you let go of losers. That is in essence a very simplified way to describe a momentum strategy. That you are staying on with the momentum on the higher side. Let's say only long only strategy. Index is geared towards long only investing. So you are basically riding the winners. You are riding those stocks which are surviving. So survival of the fittest, the evolution theory fits very well here, where every 6 months the index committee will sit down and see, out of these 50 stocks, which stocks should survive. And if they find that these few stocks from outside the system should be brought in, who have a better chance to uh, you know take the index forward, then we should bring those in. And obviously, because the number needs to be at 50, so two old geezers need to go out, and that's what happens. So BPCL and Britannia have been kicked out, although those are fantastic companies also. So the main criteria for this is, of course, free float market capitalization. So if a company outside the index, the market capitalization continues to go up, and based on the free float meaning what is available for purchase and sale in the market in terms of the percentage of the overall shareholding, uh, and the stock is liquid. So there are certain liquidity and trading volume related criteria and some impact cost criteria. So as a stock goes up, it starts to compete for a position within the index. So Zomato, for instance, has done well, and hence it is now competing with one of the Nifty stocks, that you need to give me a position in the Nifty, and something else needs to go out. And that's how the stocks that are doing well in general find a place in the index. Now Nifty is at the top of the pyramid of the index hierarchy. So there's Nifty, then there is mid cap, sorry, Nifty Next 50, then there is mid cap, then there is small cap, then there may be micro cap, so on and so forth index. So stocks move from one index to the other as they go up, and stocks move from the top index to the bottom as they come off. So for instance, uh, Yes Bank was in Nifty at one point of time, and then it collapsed so hard that it was not even a mid cap, and then it came below probably like a small cap at one point of time. So the idea is that you are nurturing outperformers. So you're weeding out the weeds from your garden, you're throwing them out, and you're nurturing the flowers that are blooming. Now, rising stocks obviously make the market cap of those companies go up, so they are captured into the index, and the essence of momentum strategy basically is being uh, showcased within the index itself. Now, the the fact remains that a lot of times what happens is that when stocks come into the Nifty index, especially, they come from a space where they were not overly researched, focus was not there on them as much, and once they come into the Nifty, and every fund manager and global manager is watching that stocks, doing research on it, they become like over owned and over researched stocks, and they kind of lose that that grip that they had on performance while coming up. So that also happens, that it's a irony that stocks come into Nifty because of their performance, and once they come in, the guys who actually go out start performing better. That cycle also plays out at many times. Um, this automatic rebalancing which happens every 2 quarters in an index is just like the weekly or the monthly rebalance that we're doing in a momentum strategy, for instance. So here the manager will see the performance basis the last week or the last few months, and they review it every week or every month, and there they're doing the same but on a 2 quarter basis. So another example could be like Reliance Communication. Everybody's forgotten about the stock. um, this was part of Nifty. So Reliance Communication was part of Nifty, and it was part of Nifty when it was 750 rupees, but then it collapsed, and then at when it reached 92 rupees from 800 odd, after having lost nearly 90%, that is the point where it exited from the Nifty. So this entire period, as a Nifty holder, you are having to have participated in the RCOM's downward journey. But nevertheless, at some point, it got exited. Yes Bank is another case where in 2011, it entered Nifty after doing 6x in 2 years. So, bulk of the move actually was missed before the Nifty 50 entry, and it replaced RCOM in Nifty. And then, for the next 7 years, it went 7x, and obviously it helped the Nifty in that period. And then it collapsed. And you were holding the bag of Yes Bank within the Nifty index till it became almost 10 to 20 rupees. After 98% fall in March 2020 is when the index committee said, okay, we are getting Yes Bank out of Nifty. Another example could be Vedanta, where we entered in 2006 into Nifty and exited in 2014. But you can't see this on the log chart, but the fall that happened before the exit was almost 70% here, and then it performed post that. Uh, Z Entertainment entered in 2017 into Nifty, and then it collapsed 75%, and then it exited in 2020. So there are so many examples that stocks come into Nifty when they are completely hyped, and they lose that move that they had in their stride, and they are then exited later on. DLF is another example. It entered in 2008 when it was at the height of the real estate boom and the stock market boom in 2008, high market capitalization. Um, and then from whatever 6 800 700 rupees, and of course it did go to about 900 or 1,000 rupees, and then collapsed, and then nearly around 200 rupees it was exited in 2011, 75% loss on that. So current rejig in the Nifty, it's difficult to say what these stocks will do, but BPCL certainly is not looking like a stock which is going to just fall down and roll over. In fact, its exit from the Nifty may help it go up. So far, in the last few years, since 2018, it hasn't done much. It's up only 4% in the last 7 years, while Nifty has done 135%. So that is the reason why it is getting kicked out. But likely is that after it gets kicked out, it'll go back there. Another one is Britannia, where It since August 2020, it is up only 25%, and of late, of course, it has lost ground along with other FMCG counters. Since August 2020, Britannia is up 25%, while Nifty is up 109%, and hence it is one of the weak links in the Nifty as of now, and that's getting kicked out. What is entering is Zomato. Now, Zomato had this beautiful run in 2023 from 50 rupees to nearly 300 rupees. That, of course, is not getting captured in Nifty, and from 300 it is now down to 200, and now we are getting into Nifty after this spectacular performance. Now let's see where the Nifty inclusion will take Zomato to. Zomato has done very well versus Nifty Junior, where it was a part of the listing, but versus Nifty, it did well before entry. Now let's see what will happen post entry. Post that, within the Nifty Junior, however, Zomato did extremely well, up 330% versus Nifty Junior at 54%. So the takeaways here is that index inherently follows a momentum style approach. The index constituent is not based on value. So when your market leadership, the index which leads the market is based on momentum, uh, I see no reason why, as an individual investor, you cannot take momentum as your leading uh, you know way of investing in stocks. It is you can say not intuitive. I take that point. It is counterintuitive. It is simple but not easy to execute, but it wins. The issue is that it wins and does not give you heart attacks. You will follow a perfect crystal clear strategy of what to buy, when to buy, how much to buy, and when to sell. And you will not be left hanging in terms of, when stock is going down, whether it will bottom now, whether it will bottom 60% lower, should I average this, when it will come back. All that goes away. You have a very nice, peaceful sleep, because knowing that your strategy will be able to pick winners in every run that happens. And believe you, in your lifetime, you will get many such runs. You just need one or two to be done in perfect sync with your strategy, and that's all you need to do. So by holding the largest and most liquid companies, index investing captures long-term winners, and is very much like the momentum investing. And the index may retain underperforming stocks longer than ideal. So hence, you need strategies which are one up on the index, where you don't have to hold the bag while the index committee is going to take 6 months to throw it out. So you should be out of stocks much ahead of when the index throws them out. So and few heavyweight stocks can disproportionately impact index returns. So that also gets taken care of in a momentum strategy, where most likely you're not allocating 50% to banking and finance like it has been in the index. So let me know in the comments what is your view about index as momentum strategy, and how you see momentum strategy as a component of your overall investing style into the market. What has been your experience with index based instruments, and do you agree with this perspective or not? Do let me know in the comments. Please do like these videos. We do spend significant amount of effort to make them, and it will be great motivation for me and my team if you would to like these videos. Do like and share these videos, and do subscribe to the channel, and I'll see you in the next one. Bye.